Can one of you just confirm whether you can hear me? Then we can start. I've also shared a presentation. Priyadarshini, can you hear me?
Yes, sir. We can.
Can you can see the slides, no?
Yes, sir. We can see.
Not the slides, the handout. Okay, so we will start then. It's 6:30. So I think last week we discussed about this ERM frameworks, the COSO ERM framework and the ISO 31000 framework. So in the ISO 31000 framework, there is a lot of responsibility placed on the board and the management, right? The board is responsible for overseeing risk management, and even in an MCQ, if you see the word overseeing, then you should ideally select the board, right? And they have overall responsibility for ensuring that risks are managed and the system is effective. Management generally is responsible for setting the risk appetite according to the standard itself. Risk attitude is defined as organization's approach to assess, eventually pursue, retain, take, or turn away risk. So it's basically we're talking about the risk appetite here, but with the attitude of the company in terms of risk, are they risk averse, risk neutral, or risk aggressive? And it also encompasses the processes of identifying and managing risks. So there again, you don't have to worry too much, but just understand that the board has certain responsibilities and the management also has certain responsibilities, right? So if there's an MCQ question where they ask you who is responsible for setting the organization's risk attitude, select management, right? But at the end of the day, we all know that the risk attitude is more or less reflected in the risk appetite statement that organizations prepare. That is a document. And then that document is finally approved by the board. So it's a little confusing at times, but to get through the exam, you need to know certain theories, certain definitions as per the textbooks, right? So in reality, the risk appetite, which reflects the risk attitude or the risk exposure that the company is willing to undertake in pursuit of value or its goals, is the risk appetite statement, and that at the end of the day needs to be approved by the board. And when the board approves the risk appetite, the management has to carry out its activities within the risk appetite. And if they're exceeding or coming out of the risk appetite range or thresholds, then you have to inform the board. The internal audit activity is responsible for what? The internal audit activity is responsible for providing assurance regarding the entire risk management system. So we have a evaluation role. We provide assurance. If they ask in an MCQ who provides assurance to whom? The directors. That the risk management system is effective. It's working properly and it's effective. So ISO 31000 assurance approaches. ISO 31000, I think discussed it last time. So if you go back a little bit here, when you look at the ISO 31000, they are talking about principles, framework, and processes, right? So it's a principle-based approach to risk management. That is important for you to remember. It's not a prescriptive rule-based approach. It's a principle-based approach where they give you the overarching principles. And then we have to adopt those principles. Its principles are the foundation for risk management. And they say the principles communicate. What does it communicate? The characteristics, value, and purpose of effective and efficient risk management. So if a company has a risk management process, then the risk management process must possess certain characteristics, right? Give me a second. So they say according to this that the risk management function, risk management framework, risk management process needs to possess certain characteristics. What are those characteristics? It must be integrated. It must be structured and comprehensive. It must be customized to the company. It must be inclusive, where all stakeholders are considered. It must be dynamic, agile. It must be based on best available information. It must take into account various human and cultural factors, because you can have the best processes on paper, the best framework, but if the human and cultural factors are not in place, if the human and cultural factors have its own deficiencies, in a sense, the wrong values, the wrong tone at the top, the wrong mission, the wrong vision, the wrong management style, incompetent people rather than having competent staff. If the culture is wrong, you have the wrong employees, then no point having the best risk management process. And they say the risk management process must be continuously improved. So what could they ask you at the exam? They might ask you, ISO, is it principle based? Yes. But what do these principles, what is the purpose of this having these principles, they might ask. Then you must say that one of the, in a sense, these are all MCQs, so nothing to write, just to select. So the purpose of having these principles is to set the foundation. The principles are the foundation for risk management, right? The house is built on a foundation. Like that, the risk management processes, activities are built on the principles, which is the foundation. And the principles are important in a sense, they communicate the characteristics, value, and purpose. CVP. What does it communicate? What do the principles communicate? What sort of characteristics should the process possess? What sort of values should the company and the staff have? And what is the overall purpose of effective and efficient risk management? The purpose, no? Right? So all that refers to the principles. So I hope now you know, if they ask you anything about principles, it's about CVP, characteristics. It communicates the characteristics, values, and the purpose of risk management. Value creation and protection are the purposes of risk management. That is also very important. Anywhere in the exam, they ask you, what is the purpose of risk management? Then risk management is to identify and have proper risk treatments. Risk management, no, the answer is wrong. Risk management is about protecting shareholder value. Answer is wrong. Risk management is about creating value and protecting it. So when you talk about creating value, it's not just the shareholders, it's all stakeholders, right? So the overarching purpose of risk management is value creation and protection, right? So those are some of the points that you need to know, and it must be an integrated approach, integrated into all activities. In a company, there are so many activities happening in different departments, and this risk management should not work in silo, where only the risk management function focuses on managing risks. Every department, every staff member, every activity, it may result in creating risks for the organization. So risk management must be part and parcel of daily operations. It must be integrated into even the smallest tasks. If it does create risk, it must be structured. That's why we have a framework. If you look at the framework, it will talk how to identify what sort of risk governance or management should be there, what are the committees that should be there, what is the board's role, the CEO's role. So all that is defined. So risk, I can remember, if we just go back a little bit, you're talking about risk, right? There's a lot of things to learn here. Let's go back. Yeah, you talk about risk, you have to look at all three elements: the culture, the governance, the people, the organization of risk management, and the process. All three areas, right? must be considered. The risk cultural aspects, governance aspects, and the processes, right? The tasks. So all that needs to be thought of. It must be customized. You can't just take ISO and implement this 31,000 framework into your organization. It might be a little too mature, a little too a little too advanced for your organization. Then you have to customize it, right? Because only the principles are stated in a framework. You have to customize it. Inclusive means there are so many stakeholders. You can't forget about the wider community. You can't forget about the suppliers. You can't forget about the employees. You have to think about everyone. So it must be inclusive. It must be dynamic. Can you see? Dynamic means what? Dynamic means you foresee risk. Risk management can't be an afterthought. No, it can't be a reactive process. No, you must foresee, recognize, and react. Before getting to react, you have to proact, right? Be proactive instead of reactive. So if you want to be proactive risk managers, you have to, even as an internal auditor, you must foresee and provide insight or foresight, more than insight, foresight to management about the risks that they may be, about the risks that the company faces. So it must be dynamic to the extent where you foresee risks. You have the ability based on various information, based on best available information, which is past, present, and future, internal or external. Based on that, you should be able to foresee. These are the risks. So it must be a dynamic process, right? The opposite of dynamic is static. Then the human behavior and cultural aspects, they all affect the risk management. The employees do not care about risk. If they don't know about the risks, then that's a huge issue. Then continuous improvement, we all know, like CPD for us, continuous professional development. Even processes like risk management also need to be continuously improved. So these are the principles. 1, 2, 3, 4, 5, 6, 7, 8. 8 principles. Then they say here, the 6 components. This is what do you mean by the risk management framework? All this is theory. So in the exam, you might be asked space. They might have a space and say is a set of components that includes leadership, commitment, integration, and all that. So then the word they will say risk management framework, risk management policies, risk management elements. They might have. So the answer is risk management framework. Where they talk about a set of components, frameworks are always a set of components. No? So how many components are there? Is leadership and commitment a principle? No. But of course, leadership and commitment will come under number 2, in a sense, right? Under this, right? And it will also have a little bit to do with number 7. But what is, then look at the second component, integration of the framework into all facets of their organization. So that is, integration could be integrated. It is a component coming under this principle, number 1, right? Then the design. When they talk about the design, they say when you're trying to put in place a risk management framework, one thing is the leaders must be committed to the framework and give this risk management function the necessary leadership, the commitment, the resources, the authority, the responsibility, all that must be given. So all that is leadership and commitment. Integration means integrate into all aspects, like we spoke about under the integrate principle. Design. There must be, the risk management framework must have a proper design for what? How to understand the organization's context. Then how to, for us as internal auditors, then as the board management, how should they articulate commitment to risk management, right? Commitment to risk management is very important. Once in a way, management, CEO, board, audit committee, risk managers, risk management committee, IRMC at the board level. Managers, they must talk about their commitment to risk management. Then about communicating authority responsibilities, a framework, allocating resources, establishing communication and consultation. All that. Then implementation of the framework, then evaluation of the framework, right? Is the risk management processes, are they, when you measure their performance, is it effective? Does it keep our risk within the risk appetite statement? Are our risk treatments effective? Improvement, continuous improvement. So there are, as you can see, the components, the 8 principles are overarching, which means they sit right at the top or right at the bottom. It's a foundation. Then let's assume that the principles are right at the bottom. It is the foundation on which risk management is built. Then on top of the principles, you have the framework, which has 6 components. And they say leadership commitment, integration, the design, right? They say that the design of the framework should include certain things. Whatever the design, it must understand the organization and its context. Proper understanding the organization and the environment within which it operates. Then only you can identify the risks. And there must be the risk management framework must be properly designed to the extent where risk management, the commitment to risk management is articulated by those. Then they say you need to assign responsibilities, delegate authorities, accountabilities for risk management roles. I mean, that also must be properly designed. Imagine your design does not take into account what is happening outside in the context. Imagine if you have a risk management framework which does not take into account the importance of articulating commitment by the senior management and the board. Imagine you have a risk management framework without having a properly designed roles, responsibilities, structures, and all that. And the resources, the number of staff. And the other element is establishing communication and consultation. That's about all the communication channels and the reporting and all that. Then implementation of the framework, evaluation of the framework to see should be evaluation of the framework's effectiveness involves measuring performance. So evaluation means actually not improvement. To improve a process, you need to evaluate it. So here you see you have a risk management framework, and here you have to in some way measure your KPIs or KRIs and evaluate how effective is this. So you have to have a process of measurement. You have to have a process of measurement. What are the goals? These are the actuals versus goals, actuals versus KPIs. That is the evaluation. That might show that the risk management is effective or not. And if it is not effective, you go into the 6th component, which is improvement. You have to improve. You can't, risk management framework is not cast in stone. It has to be dynamic. Can you remember one of the principles in risk management, we said here, it has to be dynamic, right? And then continuous improvement, number 8. So continuous improvement aligns with the 6th component of improvement. So principles overlap with the 6 components, but for the exam, just know the definitions. What is evaluation? Evaluation means if looking at the effectiveness. So if they say they have processes in place to measure performance against expectations, they are referring to evaluation. If they tell you that there is a process in place to make changes to your framework, they're talking about improvement. If they talk about having a framework which is integrated to all facets of the organization, they're talking about the integration aspect. If they talk about adopting a policy that establishes a risk plan approach, and at the senior management board, if they talk about the board and senior management demonstrating leadership and commitment, then they are looking at leadership and commitment, right? So just know the definitions carefully before the exam. Also, these are some areas where you have to quickly read up, otherwise you'll just get it all wrong. Then so under ISO, you have principles How many principles? 8. Then a framework with some 6 components and the processes. So these are all overlapping to some extent, but principles sit right at the bottom, forms the foundation. On this foundation, you have the framework, and inside the framework, you will have the processes, the mundane processes. The risk management processes consist of the following: communication, consultation, aravama thamai thing basically. Scope, context, criteria, how to identify, analyze, and evaluate risk treatments, recording and reporting. Can you remember this diagram? So take a picture of this diagram. Take a picture of this diagram, take another picture from your phone of this diagram, right? And then take the third picture of this and keep it in your phone, and occasionally have a look at it. Take a picture and have a look at it. Very easy for you. Then we go on to responsibilities for risk management, right? So board we know, management we know, and then here assurance approaches, right? Now, ISO describes 3 approaches to providing assurance on the risk management processes, right? So now you're an auditor. You're an auditor. And as an auditor, you're asked to provide assurance to the board. Can you remember that also we saw somewhere? No? When we went up here, right? We went up, we saw somewhere, sorry, it was here. No? Wait. Yeah, here we say, can you remember this? Internal audit activity is responsible for providing assurance. But how, as an internal auditor, do you provide assurance? How do you provide assurance? So there are 3 approaches, and you will have to have some knowledge of this. A key principles-based approach, a process element-based approach, and a maturity model approach. So this also could be tested. No, luckily you don't have to write pages and pages on this because it's all MCQs. So you need to just be aware that there are 3 ways to provide assurance as an internal auditor. So one is you learned about 8 principles, and you see you have a checklist to see whether those principles exist or not in practice. The key principles approach evaluates whether the risk management principles are in practice. So you have to make a small checklist. At a very macro level, you can see, is the risk management process inclusive? Is the risk management process integrated? Is the risk management process structured and comprehensive? Is the risk management process dynamic? So for all these 8 elements, to see whether they exist or not, you will have to prepare a small checklist. So you can now do some research on the internet. You have to see, even when you're auditing now, these are things now what you can do to improve your audit reports, because everything is risk-based, right? So process element approach, whether the process elements approach, whether the risk management elements have been put into practice. Elements. What are those elements? Here, process elements. These are whether all these processes are there. Then the other thing, the last one is the maturity model, right? The maturity model. Now here, they are talking about how many maturity models? 2 maturity models, right? What are the 2 maturity models? Capability maturity model, CMM. There's another maturity model, CMM with an I at the end, integration. CMM and CMMI. The first model came out, I think, I don't know, I can't exactly remember, many years ago. Let me just see. In 1990, my God, long time ago, the CMM. So CMM model came out in 1990. Who developed that model? The Software Engineering Institute at Carnegie Mellon. Carnegie Mellon is a top-notch Ivy League university in the United States, Carnegie Mellon. So in their software department, Software Engineering Institute, one of the institutes at Carnegie Mellon is a Software Engineering Institute. So the CMM model was developed. The main task assigned to this model was to measure the maturity levels of a software development process in an organization. So can you see now? So for software purposes, so developing software programming, they developed this model. So now they are using this model which was developed keeping in mind the software development process, programming. Now they are trying to use this model for risk management of anything. You can use this model. It has 5 stages. It has 5 stages. What are those 5 stages? It came out in 1990. It evaluates, right? What does it evaluate? It evaluates the process maturity levels in software. It's a very process level thing. So if we and what are those 5 stages? Initial, repeat, defined, managed, and optimized. If you look at your note, initial, repeat, defined, managed, and optimized. Several years ago, about 5 years ago, where I work, since we are part of an international network, they wanted to carry out an audit for information security aspects, right? So they sent us a report. So they asked us a lot of questions for backup. Do you have a practice in place? Do you have a written document in place? Send us a checklist. So for all the key activities in information security, like for example, software development, software acquisition, logical access controls, backup processes, encryption, data protection, data confidentiality. They selected about 10 areas like that. And for these 10 areas, right? For these 10 areas, they sent us their final report. So I expected them to send me a kind of an observation list. Instead of that, for each area that I mentioned, backup processes, configuration management, logical access controls, data encryption, endpoint user protection, they send me different levels. They said this process, this area is at level 1. This area is at level 2. This area is at level 3. So wherever we said we don't have a documented IT policy, they said, they asked us, do you at least have a practice? If you have a practice and if it's repeatable, then they put level 2. If we have not defined it, they put it at level 3. If we have a practice and we measure the performance also, not only having a practice, we have a KPI and we measure it also, the actuals against a standard. And then if it's improved based on measuring actuals and standards, then they say we are at optimizing. So all our processes came at 1, 2, 1 and 2. Nothing came at 3. So then we quickly, based on this, we developed all the IT policies. Complicated stuff. So let's see how you can use, for example, when you evaluate the risk management function in a particular department, you can use this table. You can tell where they exactly are. If they are following some, you go to the head and ask, what are the risks? We have a few risks in the department. These are the risks. Have you prepared a risk register? No. So then obviously they are at level 1 or 2. So now your risk management processes, what do you have? How do you identify? We don't have a formal process to identify. Then it's at 1, initial. Few processes are defined, not defined in a sense, not documented anyway. So like that, you have to see. Based on the maturity level, you can use this even at a process level, you can use it even at a functional level. So if there are few processes are defined, they are more like practices. They are more like practices. But if there is a process, they may have defined it, but not documented it. But at least it is defined to some extent, not in writing, but then it's initial. If it's standardized in some way, if they are following processes and you can see all are following the same process, it is a practice. No? At level 2, it is a practice, but still the proper standard is not documented. There has to be a standard. No, standard means this is the level at which it should be done. Right? They say this is how a journal entry should be raised. This is the standard. This is what you have to follow. But if there's a general process without SOP, general process which they follow, then it's a practice. Then you can say they are at least at repeatable. Staff know that when journal entries are raised, they should print it out and sign off. It's repeatable, but it is not defined as a standard in SOP. But managed means they not only, general journal entries, of course, you can't put a KPI. But in a sense, if it's some other process, sometimes you can define KPIs for it. So if they have a process, not only they have a standard, they measure the actual versus the standard and they compare, then it's managed. And then optimizing is the final level. So this capability maturity model was introduced in 1990, very old. So in later on, right? When was it? In 2000 odd, right? In 2000 odd, 2006 apparently, 2006. So that's 16 years later, 1919, the first model. The second model came out in 2006, 16 years later, again by the Software Engineering Institute at Carnegie Mellon University. So this was defined, but here the main difference was that the first came out in 1990, second one came out in 2006. So the second one, it was more integrated. CMM is capability maturity model. CMMI is capability maturity model integration. It was more integrated. And here what they say, right? Here what they say is the CMM model was developed as the first major software maturity evaluating model. It's mainly software based, though we use it for other functions like risk management. CMMI emerged as a successor for CMM to overcome whatever the shortcomings. So the way 5 stages are different. If you look at this, it focuses on organizational performance. So earlier what happened was under CMM, they wanted to see whether the task was done. Right? The task was done. So some tasks were not defined at all. In the second stage, tasks were carried out based on some standardization which was not documented, but you could say that there is a practice. Then some tasks, they defined it in the SOP and said this is the way the task should be done. And then they had performance measures to see whether the task was carried out like that. If for example, you're supposed to cut a t-shirt using the scissor in a certain way, they check to see whether the t-shirt was cut in that way. So performance measures were set more to see whether the task was carried out in a certain way, but not to see whether the task was effective, whether it gave the right results, right? So when you look at CMI, it focuses more on the results, more on the performance, because carrying out a task in a certain repetitive way can be efficient, but it may not be effective. But in CMMI, which is version 2, it focused more on the performance. So if you look at it here, it says here, incomplete, whether the work that needs to be done is not documented. Initial means you know what the work is, but the work is carried out but not according to time. So it's more project based, more organizational performance. The third one, projects are planned, implemented and managed and monitored. Fourth one, it's defined as a standard. Fifth one, quantitatively managed. The performance is managed. The performance is mainly tilted towards effectiveness, because CMM just tried to see whether now in a sense, risk management, if you use the CMM approach, you will see whether risks are properly to identify risks, whether the proper process methodology was followed, right? But you don't know whether that is the most effective way, But in CMMI, they focused more on the performance at each maturity level. They wanted to see whether it's not only whether the process was followed properly, the task was carried out as per standard, but whether the task being carried out as per standard gave the expected results, in the sense the performance standards were set. So that's the slight difference. So at the exam, what you have to know is they may have certain questions for you. I have seen on the CMM model: initial, repeatable, define, managed, optimized. So you have to know what these stand for. And then CMMI2 also more or less, you have here initial, here it starts with incomplete, initial, then managed, define. So there are certain things which are seen in both initial, defined, and managed is seen. But here you see incomplete, optimized, managed twice, no, managed once and quantitatively managed. So there are slight differences. But for you, if they talk about performance at each maturity level, not about just performing the task as per the standard, here they are looking at the outcome of that task. It's giving the correct result. So if there's anything about performance, just go and select CMMI. Remember that. So so we learned about the ISO 31000 framework. Then we learned a little bit about the COSO framework. And there is another framework, Turnbull Risk Management Framework. Turnbull was a guy in UK. Then that committee was called the Turnbull Committee. It was long ago. So in contrast with the ISO principles, the Turnbull Risk Management Framework emphasis on internal control, assessment of its effectiveness, and risk analysis. So Turnbull is the guy who mainly focused on the importance of internal controls. He's the guy who said that, we have to ensure that we must assess the effectiveness of internal control. So if you see the word COSO, ISO, and Turnbull, and if you see the word which framework emphasizes more on internal controls, just select Turnbull. That's all you need to know about risk management. Then another area that you need to know is one other unit is Unit 6, controls applications. So we have to learn a little bit about that. So do you all have any questions so far? Because today will be the last theory class, and then from next week we are going to start the questions. So then you will really understand. But what I recommend is now you go slowly and start reading these things. Because a lot of the students, candidates for exams are not sticking to proper timelines, You can get through 1 and 2, 3 is very easy. So if you can at least get through 1, then you'll be more enthusiastic about completing 2, and 3 is a cakewalk. It's very easy. So let's try to somehow finish this level 1. So we'll have a 2-minute break. If you all have any questions, you can ask me after the 2-minute break. Right. So now we will start on the next area, flowcharts. Can you see the handout? It's not very complicated, but I will just tell you the key points to remember the exam. All this you have done. Can you hear me and can you see it? Can someone confirm?
Yes, sir. Go ahead.
Right. Thank you. So here again, 35% of part 1 of the CIE exam. Can you see? So it's nearly 1/3 of the exam. it's a very important section, but it's very basic also. So in your case, it will be most likely more application of this area rather than testing of knowledge. The application of knowledge will be tested. So what is a flowchart? In the exam, they might ask you, what is a flowchart? You don't know what is a flowchart, but in definition terms, graphical representation, step-by-step progression of information, etc. The system depicted may be manual, computerized, or combination of two. So the keywords for a flowchart definition would be graphical representation, step-by-step progression of information. Right? The word data is not there because data flow diagrams is another kind of diagram that you need to know about. So when you talk about data flow diagrams, they look at the flow of data through the system. Here it's a graphical representation, step-by-step approach, right? How information is prepared, authorized, flows, storage also. Here can you see? So when you look at a flow chart, you can see who has prepared the document, what is the document that has been prepared, who has prepared it, how many copies of it was prepared, who authorizes that document, is the document preparation and authorization a manual process or a computerized. For example, if a PO is raised, the fact that a PO is raised, who raised the PO, who authorizes the PO, raising of the PO, is it a manual process or a computerized process? Then you can see out of that PO raising process, what came out, the documents that came out of it, the PO itself, and then where was the PO finally stored, in a file or in a cloud system. So all that is captured in a data flow diagram, right? And why? So it's a flow of, it's progression of information through, right? That is what is important. The flow charting allows the internal auditor to analyze the system and to identify the strengths and weaknesses of internal controls. So if they ask you what is the chart, because you have data flow diagrams, you have horizontal flow charts and this and that and the other thing. So if they ask you what is the diagram that is used, that is most helpful to the internal auditor to identify internal control weaknesses, or whether the internal controls are good or bad, that would be the flow chart, right? So flow chart, they say, as an internal auditor, we use it during the preliminary survey. Now, when you go to do an internal audit, you have to ask the company to find out before you do your what you call detailed substantive testing. You must get some idea about what in accounts receivable, payable, procurement, inventory, whatever the area you're auditing. You must get some idea about the process understanding and controls understanding you have to get. So you start drawing flow charts. Through flow charting, you get an understanding of what the flow, what the process is and what controls are there. And this is, and you do this in the preliminary survey, that is before you start the internal audit proper. Before you start your detailed field work, you do the flow charting. Now can you see? Before you even decide what audit procedures to do, you must, to get an understanding about the organization, you must do your flow chart. It's a preliminary step kind of thing, right? Then you go down, then you have, yeah, these are the symbols. Symbols also they ask you sometimes, they put a chart and say, what is this start point? This is a document. Second one is a document. Third one is a process, but if it's like a rectangular box, it is a computer process. If it's a kind of the two sides are flowing inwards, it is a manual process. So if the PO is raised through the system, it will be the third box, third picture, rectangular box. If the PO is raised manually, it will be the fourth one, right? So then this one, I can't use the, no, I can't use my, so one starting from the top, 1, 2, 3, 4, 5, 6, 7, 8. 8 is the decision symbol, like the diamond. That's a decision symbol. And the storage symbol, can you see? Triangle upside down is a storage symbol. So you have to know these things. You have to know these things. You have to know these diagrams. So the most important ones would be 1, 2, 3, 4. Hard drive, which is 6. Then the 7th one, which is like a diagonal diamond. Then the triangle upside down. And the one before the last, manual input into a terminal or the online device. So just know those symbols. So these are the flow charts. And flow charts are generally, and then apart from flow charts, there is what you call horizontal flow charts. Or they call it sometimes system flow charts, right? Now, because if you look at a horizontal flow chart, it's also called a system flow chart. How you find out whether it's a horizontal flow chart or a system flow chart is you just look for the departments, names of the departments at the top. Purchasing department, computer processing department, receiving department, inventory warehouse. So if the departments here, what happens is how the process flows across departments is shown. Sometimes if you want to procure something, it may start from inventory. So then inventory to procurement department to, then you have the finance department. So in a horizontal flow chart, you get to see the departments of functions arranged horizontally across the page in vertical column. So this purchasing department, you get the requisition. Then you have the computer processing department does certain things. The receiving department does certain things. And the warehousing department does other things. So just know, if you see this sort of diagram at the exam, you must be able to differentiate from a vertical flow chart from a horizontal flow chart. Now I will show you a vertical flow chart. Now if you go down here, this is a vertical flow chart. Can you see? So flow charts, we know how to define. Then we have to be able to differentiate between a horizontal flow chart. Another name for horizontal flow chart is a system flow chart. Here, if the way to define it is you look for the departments at the top and the process at the bottom, and they are called system flow charts. Then vertical flow charts are called program flow charts because it's more top down. Now you look at this. You don't know which department does what. Here it just looks as if everything happens in one department. So just know that a vertical flow chart is also called a program flow chart. And here it just gives from top to bottom the process. It doesn't show which departments are involved in what activities. Then apart from that, you have another kind called data flow diagrams. Data flow diagrams show how data, can you see how data flows within an information system and the processes that manipulate the data. So that definition is very important. Data flow diagram shows how data flows in an information system and what manipulates that data, right? So that you have to know and know these diagrams, right? How data flow, then the data store, then the process, and the entity and external to the system. Then process mapping. All these are more or less same things. Process mapping is a simple form of flow charting used to depict a client process. Below is an example of a process map. Again, you might get this confused, but from what I have seen in the exam, the most important thing is how to identify a vertical flow chart from a horizontal flow chart, how to define those, and also how to define a data flow diagram where you look for the word data flowing within a system and what processes manipulate that data, right? So process mapping, yeah, important, not very important. Then you come to various cycles. So if you look at an organization, you have accounts payable, you have accounts receivable, you have inventory related processes, that you have financial processes, so many processes, but we'll look at certain features. A properly designed system of internal controls should reduce the risk of errors and prevent fraud. The reason why you have internal controls is to prevent and detect fraud and errors. Now, when something goes wrong, if it is done purposely, intentionally, If there is an invoice and your revenue is 100 million, someone goes and raises an invoice for 20 million to intentionally increase your revenue to 120 million intentionally, so that you could show a better profit, an enhanced profit or a higher profit. That is a fraud because it was carried out intentionally. But if someone without raising an invoice for 2 million goes and mistakenly adds another zero and it becomes 20 million, and thereby your revenue goes up to 120 million. But there, the difference is that would be considered as an error. What differentiates when something goes wrong, it could be due to an error which occurs unintentionally, where a person does something but unintentionally. There was no intention to deceive. But when something happens, when something goes wrong because someone intentionally wants to deceive someone, then that is a fraud. So the purpose of controls, internal controls, is to reduce frauds, reduce errors. What differentiates an error from a fraud, or what differentiates a fraud from an error, is intention to deceive. And here they say there must be proper segregation of duties in an activity or a process that we are auditing. And the cost benefit also must be considered. Whenever we recommend controls to an organization, we have to see whether the cost of implementing that control exceeds whether the cost is less than the benefit. Right? You must do a cost benefit analysis. Every time you recommend something in an internal audit report, do a cost benefit analysis and see whether the cost, the control that you're recommending is worthwhile. It will be worthwhile only if the benefit outweighs or exceed the cost of the control. Segregation of duties is also another thing that must be thought of. If you take a purchase order, the person who raises the purchase order, record keeping, the person who raises the purchase order must be different from the person who approves the purchase order. The recording and the authorization must be done separately. Now look at a payroll. Who prepares the payroll? A prepares the payroll. B authorizes the payroll. C disburses the checks. 3 people. Let's look at something like making an investment in a fixed deposit in a bank. The documents are maybe authorized by the board to do FD, to create an FD or deposit 100 million at HNB. Maybe the decision is authorized by the board or the investment committee, so authorization is done by them. But who records it in the books? The finance department. Then who is the custodian of the fixed deposit certificate? Someone else. The authorization of the transaction, the decision to invest in a fixed deposit, is made by the board. Who records that fixed deposit in the general ledger by going and crediting cash and debiting fixed deposit investment account? That will be done by finance, someone, accounts executive perhaps. Then at the end of the day, who is the custodian of the asset? Who has the original fixed deposit certificates? That will be the CFO or someone else, right? So the internal control system is designed to detect fraud by one person, but not fraud by collusion or management override. That is very important point to remember. What does that mean? Can someone tell me what this B means? What does that mean? What it means is that we can have the best internal controls in place, but if 2 people get together or there is collusion means more than one person is involved in the fraud, right? You have a cashier who is supposed to go and bank the funds in the bank, and then you have an executive in finance who checks whether the total receipts are banked the following day. So if the cashier carries out a fraud, the executive will detect it the next day. But if both of them get involved in the fraud, and if there is collusion, that important internal control is of no use. So collusion destroys controls. The person who is supposed to detect it also is involved in the fraud. Management override. Sometimes when we want to raise a journal entry, the process might be first, if it's a data write-off, the process might be it has to go to the board. It has to be first prepared according to the internal policy, what debtors get written off, then it must be going to the board for approval with the finance director's recommendation, then after approval, then the finance executive raises a journal entry. That is the process. But if a director says, raise this journal entry, overriding all controls, the executive might raise it, because the management has the authority, may not have the full authority to do it, but out of fear, executives may do. So there is the possibility of management override. Management override generally means managers overriding controls. If you are supposed to follow ABC controls when you do a transaction, management says, no, do this and no need of control, just raise this entry. Raise this invoice in the system. Right? They can do that. That is dangerous. The term management override generally refers to what? The ability of management or those charged with governance. Those charged with governance means directors to manipulate accounting records, to prepare fraudulent financial statements by overriding controls, even where the controls might otherwise appear to be operating effectively. So controls appear to be operating effectively, but management can say, raise this, do this. They can override controls. Right? So to be very, very careful about management override of controls. Management override of controls means controls are not carried out. Sometimes the management, there is segregation of duties. Sometimes management, without following the correct process, may be even authorized sometimes to do certain things, but illegal. So there again, there is override. Because management is empowered to override sometimes, no. Management is empowered to override. They have the authority to override, no. So you can misuse that. You can misuse your what you call your authority, and especially during COVID times, we saw that management overriding controls. Do you have any questions? Do you have any questions?
Excuse me, sir. You mentioned about the segregation of duties is how it should be maintained between purchase order and maybe the raising of GRN and everything. Let's say now purchase order itself, there are two signatories. GRN itself also there are two signatories. Maybe person who raise and the person who confirm. So in such a situation, no, is there a problem if one person name in one document and the maybe purchase order and the GRN? Is it a problem?
Yeah, it's like this. If you take the PO must be raised by A. It cannot be authorized by A. It has to be authorized by B. If you take a GRN, the GRN must be raised by C, and it can be authorized by D. PO, procurement activities and inventory activities, like raising a PO, which is a procurement function, and raising a GRN, which is an inventory function, must be segregated. There are certain activities which need to be segregated at the higher level. For example, people who carry out account receivable activities should not be involved in accounts payable. People who carry out inventory activities should not be involved in GRN or procurement activities should not be involved in inventory activities, because even when you authorize a payment, you do the three-way match. You see whether the PO is available and a GRN is available. But what would happen if the same person can raise a PO and a GRN? Then he only needs to raise a fictitious invoice, and then he can send a payment for approval. So those activities have to be segregated. In some companies, inventory people raise POs, which should not be allowed. You should not allow inventory people to raise POs. They can be involved in inventory theft and to cover if they can order items, and a lot of problems. Then we move on to organizational hierarchy. In an organization, there are different levels, right? So each department must have the way a department, sometimes under finance, you get everything. Under finance, you get procurement, accounts receivable, accounts payable, everything. So then inventory also sometimes comes under finance. So you have to be a little careful. Ideally, you have a VP of operations or supply chain head. Then you have a procurement function head separately. You have a CFO. Now here you call a CAO and a CFO, but they are more or less the same. VP. So at an organizational level, whenever you do audits, you must see whether the main tasks at the highest level. We don't want one person to be responsible for accounting, procurement, and inventory. Then there itself, there is no segregation of duties. So counting, sometimes in small organizations, you might have the inventory head or the procurement head reporting to the CFO, but then as heads, they must be separate. You can have a separate head for procurement, separate head for inventory, then they may report to finance, but ideally not. Ideally not. It creates a segregation of duties issue. If you are doing that, then those heads must be given proper authorization, where the CFO cannot place a GRN or a PO. Only it is segregated to those departments. Through that, you can ensure, though they report to one another, the activities of procurement are separated from inventory. In accounting cycles, sales to customers on credit and recognition of receivables. You make sales. They say the accounting process can be divided into 5 cycles. This is what this note says. So you raise an invoice and you recognize the debtor. Then second one is you collect the cash and you set off the debtor. Then another process is like purchases on credit and recognition of payables. You purchase something and you debit purchases and you credit payables, and then you make the payment. Debit credit cash book and debit payable, and you set off the payable. And then you make payments to employees, the payroll aspects. So they have divided this according to this note, accounts activities into those 5 cycles. We may sometimes come out with more or less. This is a sales receivable cycle. Can you see this? Sales receivable cycle. So this looks more like a horizontal flow chart, no? Or a system flow chart, because you kind of have the departments at the top. Not really, but somewhat similar, no? Ideally, you should have the name of the department at the top. So you have operations here, yes. You have no sales, warehouse, shipping department, then the billing department, like this. So this is a system flow chart. So go through these flow charts. I'm not going to go through it with you, and look at the symbols. Can you see the symbols? These are all documents, no? These are all documents. When you look at the shape of the symbol, it's a document symbol that is there. So these charts also, I suggest you go through it. We'll go through one. So this is for the sales process. All the activities in sales and the critical control is given on the right. So you have to learn this now. In the cash receipts process, cash receipt cycle. So this is the process, and they have a table. In the table, they mark all the controls in all the main activities. Can you see? The purchases payable flow chart, and then they have a purchases payable control. Now look at this. Organization is trying to purchase something. So one of the activities, number 1, step 1. Inventory control prepares a purchase requisition when inventory approaches the reorder point. So they say here in this company, now you want to purchase something, but the inventory department knows when an item goes below this reorder level. Not the reorder level, goes beyond the reorder point. when it goes beyond, the purchasing department raises, the inventory department raises a purchase requisition and sends it to the purchasing department. So that is one step. So what is the control there? Control there is predetermined inventory levels trigger authorization to initiate a purchase transaction. So when the stock level of a particular item comes to the reorder level, let's say the reorder level of an item is 50 laptops and you have 100 laptops. When 100 laptops comes down to 50 laptops, it is triggered in the system automatically to say, we must now order. How many? You can have even a reorder quantity even defined. So you have a reorder level at which a purchase requisition is triggered through the system. It's all system control. Whenever the reorder level is reached, the stocks go down to the reorder level, automatically the system will give a message saying these items have gone to the reorder level, let's purchase. So that is an important control. So when you are doing an audit, you must see whether reorder levels have been defined, how is the purchase transaction triggered. Then once the purchase requisition comes, now it is in the purchasing department. Purchasing department will call for the quotations and look at the vendor masters and prepare a purchase order. That is the second stage. So in that, what are the important things when you select a purchase, when you raise a purchase order? One important thing is that you must buy only from vendors who have been pre-approved, who are on the supplier registered supplier list. Selection of the vendor. Is there a proper control there? Then reconciling sequentially numbered purchase orders helps to ensure that orders are legitimate. So you have to ensure that all your purchase orders are sequentially numbered, 1, 2, 3, 4, 5, like that. So step 2, purchasing locates authorized vendor in vendor file. So when the purchase requisition comes and says they want to order laptops, purchasing department will see who are the vendors for laptops from a list, registered supplier list. They might get quotations. Then they might go through the procurement process. So that alone is not enough. Selection of the vendor, selection of the item already has come from inventory, and selection of the rate. All that, for that there must be embedded controls. Then third step, I'm just taking one, like that you all just go through the others, because in the exam you might be asked various questions based on a scenario. Third step is what? Now purchase order is raised and it's approved in step 2. So you can break this down. Now you can prepare a better table than this. So purchase order is raised, and on the purchase order is sent to the vendor supplier. So purchase order is raised in 3 copies. A copy for purchasing. Department might keep 1 copy. Another copy might go to the supplier saying these are the items we want. Another copy might go to the receiving. Receiving, that is the warehouse where the goods are received, so that they know when goods come, they know this has been ordered. And another copy might go to accounts payable. So the purchasing department might send, or generally what happens is the copy that is received, the purchasing department will send 1 copy to the finance department, 1 supplier, 1 inventory receiving location, another to the accounts payable, and they may also have a copy of their own. Now they don't need to file it because everything is in the system. Even the approvals are in the system. Receiving copy has blank quantities. Can you see? The copy that is sent to inventory has blank quantities. Of course, that does not happen now. We send it with the quantity that was ordered. Otherwise, they'll go and receive another higher amount. You may order 50 laptops. If they go and receive 60 laptops, finished. So if the PO says 50, they'll ensure that they only take in 50. So receiving copy has blank quantities is not practiced in Sri Lanka, I think. So vendor prepares merchant for shipment to the vendor supplier. Receiving is put on notice to expect the shipment. By when the warehouse gets their copy, they know now they are going to receive this. Accounts payable is put on notice that liability to this vendor is about to increase. So accounts, when you raise a purchase order, what happens is legally, when you raise a purchase order, legally you should recognize a payable. This purchase order release means you have ordered the stuff now. So you can even recognize a payable upon delivery. So by sending a copy of the PO to the finance department, they can recognize the PO or the liability payable on issuing of the PO. When you release a PO, it basically says you have ordered now, right? But ideally, what happens in Sri Lanka is you receive you account for the payable according to the standards when you receive the goods. Till then, no, right? But actually, a PO is a legal document. Right? So then, accounts payable prepares a summary of all purchase orders and issues the day and posts for the GL even before receiving goods. Updating GL is done. Then goods arrive at receiving with a packing slip. So because quantities are blank, receiving copy of purchase order, employees cannot assume the order is correct as received and must count items. So usually we give a heads up to the inventory department on the quantities. No? If they go and if they accept a lesser quantity, that is all right. But what happens if they accept a larger quantity? You can't get the supplier to come again and go. So we tell the receiving people what the quantity is that they should expect. So then receiving prepares a receiving report or GRNs and all that. And then warehouse verifies the goods receiving match with those receiving reports. So there are certain processes there. And then the receiving report or the GRN report is sent to the finance department. So updating inventory and GL file separately provides additional accounting control. So here, what generally happens is we recognize the payable upon receiving the goods. So once we receive the goods only and the invoice, right? Once we receive the invoice usually comes not when we issue the PO to the supplier. No, invoice usually comes with the goods. So the GL generally generally gets updated for the liability for the trade payable only when the invoice is received. Then only we know the right amount. But of course, the right amount is the amount that we should recognize is also reflected in the PO. But sometimes we place POs for large quantities and tell them to deliver it in small quantities. We can order 1,000 for the year and tell every month send 100. So we will recognize the payable only when for each shipment. No? So like that, receiving also sends the receiving reports to accounts payable, ensures that vendor accounts are current. So many processes like that. Just study it. There are now here. This is the cash disbursement process. Dispersing cash. Purchasing receives. Purchasing department receives the vendor invoice. Then they will check their purchase order, check against the purchase order, and then say close the purchase order in the system and sends it to accounts, to finance to pay it. In accounts payable, the purchasing department will compare the invoice against the PO and close the PO. In step 2, once the invoice and PO go to the finance department, they will check against the invoice with the AP file, accounts payable file, and issue the payment. Yeah, they will check the invoice against the PO again and look at the payable, and they will place a payment voucher, and the payment voucher will set off the payable. Will debit payable and credit cash book. They will check the invoice numbers and all that to ensure that there is no finance will particularly check to see whether there is no duplication. Otherwise, finance can't pay for an invoice sent by the supplier twice, no, same invoice. So payment voucher will be checked against the invoice and the GRN. The payment will be processed through the payment voucher. The processes where if it's a bank transfer, then the remittance advice is sent to the vendor to tell the vendor we have paid up, and the vendor will check it at his end, right? So these processes can change in various financial accounting systems. They can have different processes. So payroll also, there are certain processes here. You can go through it. And then we have management controls. Just give me a minute. Give me a minute. Right. So management controls, they're talking about roles and responsibilities here. All this is stuff that you already know about. Management, the chief executive officer, CEO should establish a tone at the top. That's very, very important when you are doing audits. Just make sure the CEO and the head of the department establish the proper tone at the top. If not, you have to comment on it. What do you mean by tone? The fact that, controls are important, risks need to be managed, recommendations need to be implemented. The importance of all that needs to be communicated. If the CEO is not interested in controls, does not take control seriously, then the tone is wrong. Organizations reflect the ethical values and control consciousness of the CEO. Yeah, proper ethical values. What are the values? What are the code of ethics? What does that say? What are the core values of the organization? All that needs to be considered. You all have to have a checklist for this. The chief accounting officer or the CFO has a crucial role to play. Accounting staff have insight into activity. Yeah, CFO, now see, the main two figures, when you look at internal controls in an organization and the management level, there are two key figures, CEO and CFO. CEO, because he's the head of the executive. CFO, why? Every transaction at the end of the day goes through finance. So finance is the brain center. Finance must control everything, because they have insight into all activities. Sales department might know only about sales. The CFO knows about the inventory adjustments, about the procurement things, about the supply chain, about the LCs that are open, about the payroll payments, about the incentive paid. There is no department in an organization that has such insight into all activities other than the finance department. So CFO, generally the accounting function in any organization is in the second line of defense, right? Very important. They can, if they have very good finance department, they can prevent fraud to a great extent. Board of directors, what is their commitment to integrity and ethical values? When board directors are selected, when senior management people are nominated for CFO, CEO, CIO, all those positions, do they consider the ethical and integrity of that person? If you get a few horas into your organization, finished. Then I know then the selections do not reflect good integrity. The management's commitment to integrity. No point saying we are committed if we are selecting a bunch of cooks for senior management positions. If someone has carried out, I know of certain conglomerates, whenever they are entangled in some fraud, immediately they resign and go. That is the zero tolerance for fraud, right? To be effective, board members should be capable of objective judgment. Yeah, that's why you need to have board of directors. In the board, you have the executive directors and the non-executive directors. Out of the non-executive directors are people who do not take part in the day-to-day activities of the organization, like the executive director. So non-executive directors, out of the non-executive directors, some are independent, some are non-independent. The independent non-executive directors must be very strong. They are the ones who now head. Central Bank just issued a directive. They said in a finance company, head of the audit committee must be non-executive director who is independent. Head of the risk committee must be a non-executive director who is independent. Earlier it was non-executive, you can be non-independent even. The chairman of the IRMC. Now you have to be independent. Head of the related party transactions review committee also must be independent. Those are very important things. And the board must be capable of objective judgment and be willing to ask distasteful questions. They must be willing to ask those questions which people don't like to be asked. Important subcommittees must be there. They must the important audit committee, risk committee, those committees must be there with proper TORs, terms of references. This is very, very important. Internal auditors, what is your role as an internal auditor? Management is ultimately responsible for the design and function of the system of internal controls. So who is responsible for designing internal controls? Who is responsible for the functioning of internal controls? It is not the internal auditor. But what is the internal auditor's role? It is a role of consulting and advisory. The internal audit function evaluates internal controls, evaluates, reviews. Those are the words that you should look for. To remain independent in the conduct of these reviews, the internal audit function cannot be responsible for selecting and executing controls. Now, they say here the internal auditor should not select controls. Internal auditor should not execute or implement controls. What does that mean? When we recommend an internal control in a report, is that selecting? No. When we recommend, we only review and recommend. The selection, the decision whether to implement it or not is up to the management. We must never select on behalf of the management. You recommend. So indirectly, when you recommend, what you're telling the management is to do this, do that. It's a directional thing, no? Basically directing them. But at the end of the day, you must emphasize this is what we recommend. Whether to select it or not, whether to implement it or not, is up to you, not up to us. Everyone in the entity has a role to play. No? Everyone carries out various activities in the organization. So everyone has a role to play in the organization when it comes to controls, right? Imposed control and self-control. Imposed control, these are just, theoretical stuff. Today I have to finish at 8. I have a small birthday function that I have to attend. So in 2 minutes, we will be closing today's session. Do you all have any questions that you want to ask? Because we have about 3 minutes left. You can ask any questions that you have. I think it's better for us to use this time for questions. I can cover this.
It's about...
Yeah. Go ahead.
So is that about it's about a hierarchy? Where does this president and vice president fit in? Are they below the CEO and CFO, or they are parallel? How they place there?
It really depends on the organization. If you go to a US-based organization, the president sits at the top. But if you look at an organization like John Keel's, you have the chairman. Then you have a CEO. CEO is also the chairman, which is a breach, right, of governance. Then below the CEO and the managing director, you have presidents for various divisions: president of retail, president of leisure sector, president of banking, president of financial sector, like that, different presidents. Below presidents, you have vice presidents. Now in John Keel's, what happens is you have presidents, executive vice presidents, senior vice presidents, vice presidents. So president is right at the top, but above the president also there are CEOs. There is a CEO or a managing director. So generally, if you are a president, you will be either reporting to a managing director, or president means the head of a particular division. No? But in other companies, you can have one president. On all their heads may be vice presidents. In banks, you have GM and a CEO. All the others are DGMs, second tier. But in certain conglomerates now, you have this presidential structure because they want to give fancy designations to people, Otherwise, you can't use the DGM and all that in conglomerates. So head of a particular division, for financial services, you'll have one president. For retail, you'll have another president. For consumer foods, you might have another president. For leisure, you might have another president because you have to promote these people also. No? You make them vice presidents or then executive vice presidents, associate vice presidents, executive associate vice presidents, then vice president, executive vice president. After executive vice president, you can have president. In the US, yeah, so it depends from company to company. It depends from company to company. Any other questions?
So is it a segregation issue where HR managers sit in a procurement committee for selection of insurance provider, health insurance provider?
Yeah, when you say a procurement committee, it depends on the role. I mean, there are other members also in the procurement committee, no? The HR person may be put and be made a member of the procurement committee if the insurance is related to the people. HR people, right? Then he might play a more of a consulting role rather than a decision maker. So it depends on how many people are there in the procurement committee. if they are a majority are non-HR, and also then there is no impact, no, like that. But if the HR person has a big say, sometimes now sometimes when you are buying an IT equipment, the procurement committee may have the DGM of IT sitting there. But although the DGM IT is there, he's not the sole person. No, there are others also who are independent of IT. So his decision is kind of diluted. His power or control over the decision as to whether to select that IT package or not. So it depends. It depends. So in your question, very hard to say. What you're saying is the insurance is related to HR, is it?
Yes, health insurance. That is.
Yeah. So the HR. So this committee, when you say procurement, the quotations may be called. It may be evaluated by someone and put to the procurement committee. Where if the procurement committee, where the procurement item is related to HR, then there might be a process in place where the head of HR or the HR manager may be asked to sit in on that committee to give the HR's perspective. But if he's one of two, then there is an issue. But if there are about 4 or 5 members where the CEO, CFO, head of procurement, maybe another external consultant plus the HR head is there, then his decision is not, he can't unduly influence that decision. So I think sometimes they put a person related to that particular technical area just to get their input, you know. So that is there. I have seen it in some companies. All right. So we will stop for today. I have about another few more pages to do. You all read this and come, and then we can start off on the questions from next week. So thank you for joining. Take care. Have a good weekend.
Thank you,
Good night.
sir. Good night, sir.